Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community. I'm Nathan Stovall, and on this episode we're talking about the recent pressure on bank stocks and the aftermath of several large bank failures and whether that sell-off has merit or if the street is misunderstanding the situation facing the industry and regional banks in particular, which have come under pretty great stress. Joining me to talk about this on May 4th, and I want to mention the date here given how fluid things are, is a veteran of the sell side and one of the more respected bank analysts out there, Chris Marinac, Director of Research at Janney, Montgomery Scott. Chris, thanks for coming on the show.
Nathan, thank you for having me. I appreciate it.
So, Chris, we've seen the group take pretty big hits this year, and we had some hope maybe that was kind of stabilizing, but we've seen further pressure over the last month. And as I mentioned, the regionals in particular have taken the greatest hits. The regional bank index is down 40% or something like that this year. Maybe this is obvious, but what has driven the pressure of bank stocks recently? And what I want to maybe even ask that a little further is, do you think it's really a change in fundamentals, a change in the view of the group, or do you think it's really more fear?
I think it's definitely fear. I will start with fear and go to the point that I guess I feel today that banks are being used as weapons of destruction against the Fed. We have seen a lot of temper tantrums this week in the marketplace, certainly specific bank stocks, which we can talk about, as well as the whole industry, where there's this ongoing negativity. And now we have a series of articles coming out with sort of bizarre storylines, some of which are stale, some of which are just made up, I think, to kind of try to justify positions that certain folks have being negative. And there's nothing wrong with being short the market. Folks do that every day. It's how markets work, and we should keep that intact. The reality is there's just a lot of misinformation on banks, and it creates an ongoing fear. And as you know, Nathan, there has been this muscle memory going back to 2008 and 9 and 10 about the great financial crisis, and everything is an analogy back to then. And we should talk all about that because there are many experiences from 2008 and 9 that are totally different today, and many that are very similar. And the fear is definitely a look back to 08 and 09 and thinking that AIG is coming and some other, external factors going to impact these stocks. And we've had 3 banks that fail. Certainly that's plenty, and they're big enough to create worries, and the contagion fear is on. But it's getting to a point now where the fundamentals are being completely ignored. The facts from the companies are being ignored. And I think we have to take a step back and realize what's happening. There are bears who are very negative and are using the banks as a weapon of destruction to try to force the Fed to perhaps consider a blanket deposit insurance alternative, to perhaps cut interest rates sooner than they expect, or to do something else with the Fed's many tools in their toolbox to create some better environment for equity investors and, the capital markets in general.
I agree with the corollary to 08 in terms of the market reaction. I was talking about that this morning with somebody, that it feels similar in that you see indiscriminate selling of the group like you did then. And I can't remember another time in the last 25 years when we had seen that. But I do think that the fundamental picture is quite a bit different than there. And to your point on the company note, we just saw last night, PacWest comes out and says deposits have gone up, and they get hammered for it. It feels like anytime the companies are coming out and trying to say the right thing, if they say anything, it's something that somebody kind of jumps on right now. And the other thing I'd say that feels somewhat reminiscent in terms of the market reaction is you hear talk, and perhaps this is what you're alluding to, of, they're going to have to mark their whole balance sheets to market, but that's not the way banking works.
Correct.
People are making extrapolations that don't really apply to this group.
Absolutely. And we started the process in March when Silicon Valley did their crazy press release on March the 8th. We went to work going through the data we already had access to from the call reports to understand what are the true mark-to-market impact for held to maturity, because that was the problem, and quickly created what we call the extreme Tier 1 capital ratio to understand if you recalculated Tier 1 with all available for sale losses, all HTM unrealized losses, what do you have? And we've now been able to repeat that for the end of March. It's a very therapeutic process because it gives you a sense of what the numbers are. Now, a lot of the bears believe that you need to take one step further, which is to flush all loan losses against that. And they're using what's called the FAS 107 marks that are in the 10Ks. And I certainly appreciate their point, but I don't think that's how banking works. I also don't think most of these companies are getting sold immediately. And to some extent, that process ignores loan loss allowances and CECL unfunded commitment reserves in place, and it also ignores earnings. And while earnings are under pressure, there still are earnings. And a point we made in a separate Janney piece this week is that PPNR, pre-tax, pre-provision net revenue, which we think is the cornerstone of the Fed stress test process, and also operating cash flow for a bank, that PPNR affords you 500 to 600 basis points of losses the next 2 years. And if you want to dial that down because you think it's going to get compressed for net interest margin pressure or for balance sheet pullbacks, that's okay. I mean, if you want to make that an 18-month process instead of 24 months, that's okay too. You're still going to have 3, 4, 5 points of coverage just on earnings alone before we go into tapping reserves, tapping allowance. And I don't know that the losses are that great. Just because the FAS 107 marks say so doesn't make it accurate. So the next piece in the conversation really should be how and when will we all do loss given default analysis, which I think is really what banks already do internally to justify the reserves and where they're going. I think that is the process that is completely being ignored, and mostly because most investors don't really know how to do it, and most banks are shy to talk about it. But with stock prices deep in the hole, banks are going to have to open the kimono even further. Although I have been very pleased with the disclosures we've seen in the past month from first quarter earnings. Banks willing to put information out has been very helpful. It's made it easier than it was for you and I back in the fall of 2008 when it was similar chaos and similar results in the stock prices.
And absolutely. I think that last point I want to pick up on and go back to one before too, but in 2008, people were kind of quiet and there was more of sort of nothing to see here. I've been appreciative of the proactive moves by management teams to really, really get detailed on where their liquidity position is. Unfortunately, it's not been appreciated by the street. I think that's all they can do. To your point about the loss coverage there, I hadn't seen those numbers, heard those numbers, but if you think about those numbers, that's a tremendous amount of loss coverage. You know, you're almost implying loss content a la the GFC, it sounds like, in terms of what they could support without, maybe not quite there, but it's a pretty severe scenario. And that does not feel like what's going on right now. I mean, these are effectively rate marks. It's not to say that there's not credit risk out there. It's not to say that there aren't some things to be worried about and that loss content isn't going to go higher. It will eventually, right? But these are rate marks. That's the issue here. This is not like poor underwriting decisions for 10 years or even, you could argue, 30 in terms of economic decisions like we saw heading into 2008.
There's some interesting nuances that came out of all the disclosures in April, and two examples I'll cite are Fifth Third and Synovus. Both Fifth Third and Synovus said that a meaningful percentage of their AOCI was going to come back in the next 2 years. Actually, with 7 quarters, specifically at Fifth Third, that they'd have 45% of AOCI returning to them by the December quarter of 2024. I thought that was huge. I know because of the way Synovus's portfolio is set up with a high degree of mortgage-backed securities, residential mortgage-backs, that they have a lot of cash flow and that roughly 30% of their AOCI should be coming back to them. And that's meaningful. That means you should have more confidence in the Synovus and the Fifth Third tangible book value and also in their ability to write off losses if indeed they happen. I think both of those are way better lenders than investors think, but we still have the theoretical loss capacity, and that's what's being ignored by the marketplace. And I meant to say earlier, remember that the bear case always sounds more intelligent. It's just human nature, and I've learned that over my career since the early 90s, and sometimes you just have to bite your tongue and understand that the bears are winning in the short term, but that doesn't mean that they're going to win the war. They certainly didn't win in 2008-9. I don't think they're going to win now. We just have to tough it out. We just have to have the perseverance and determination to keep marching ahead.
Turning to Q1 earnings, what sort of takeaways do you have from a fundamental standpoint? To me, it flew in the face of a lot of what you're seeing there. Now, no doubt you saw some serious liquidity pressures, but it seemed more like an earnings issue, albeit with a handful of outliers there, rather than some sort of discussion around safety and soundness. Would you agree with that? Maybe you were more concerned, but how do you think about those results and what it told us about bank liquidity broadly?
Well, companies were raising liquidity just in case. There was a lot of just in case and just in time liquidity maneuvers in the last 3 weeks of March. Banks taking on brokered funds, banks increasing their capacity, even being able to dial up with the Bank Term Funding Program, the brand new tool of the Fed. Not that they were using it, but just that they had access to it, including that in their available liquidity. So all of a sudden, there's a honest discussion about the real number of uninsured deposits and the real number of liquidity access. And most banks increase cash from December to March. So to me, that's a win. The use of liquidity and stepping up is a win. And I think that there still is a somewhat of a unknown understanding of how liquidity actually works. And we've tried really hard to not only understand liquidity, how it's modeled, how the examiners and the home loan bank look at it, and continue to think through. I think liquidity as a mistake, as me as an analyst, has been that we didn't stress liquidity enough. More about the cost of liquidity, less about availability. Clearly, availability was an issue at SVB, but they also made a whole series of mistakes, and they just couldn't react within 6 hours to save themselves. And it is what it is. But the rest of the industry, besides Silicon Valley Signature, FRC, they really sit in a much better position. Even if we talk about PacWest and Western Alliance, they're in a much better position, and they've done some really good things on liquidity in the past several weeks. The market's ignoring them, but then the market ignored stuff in 2008 and 2009 as well. So it's very reminiscent of what we lived through 15 years ago.
I remember the first release that Western Alliance in particular put out, and I remember reading it and thought, man, whoever was the PR person, the media person who helped write this, this is great. And I scrolled to the bottom, and the CFO, Dale Gibbons' name is right there, and thought, oh, yes, this was written by a CFO, and just tried to attack line by line that negative narrative out there to the point that you had mentioned several times before of they're coming out there with really specific disclosures, different levers they have to pull. And again, that comes with a cost, sure, but that's not the narrative that's flying out there right now. The narrative that's flying out there right now is that some of these guys are burning down.
So from a standpoint of Western Alliance, they have been very proactive to change the narrative. You can argue that it's not working in the short term, but discipline equals freedom, as one of my favorite mottos, comes from a military professional. And you really have to think through doing a same repeated process, and it will eventually set you free. And I think eventually the short sellers, will have to change gears as people see the facts of these companies, even though they're clearly trying to use the banks to force deposit runs and therefore force the Fed and the Treasury to act. That's kind of what we sit at today at this hour. But we'll deal with that. We've certainly had, I think, worse things that happened in the last crisis than this. It just feels pretty awful at the exact moment.
And some of those worst things being that they literally didn't have options, whereas this is just sort of a negative narrative. And one of the things very different, I touched on this on credit. Did you hear anything coming out of Q1? Again, expectation credit costs normalized for sure. They definitely go up. But I was struck, in fact, that you saw quarter over quarter declines in provisions, not across the board, but in a lot of names. To me, especially in a CECL construct, that suggests that they're not really seeing a lot of stress with their borrowing base. But perhaps you had kind of a different experience. But I'm curious, what were your takeaways from a credit perspective in Q1?
I think credit was going to be calm with limited losses and limited problems. It was what I expected. I think that criticized and classified assets combined, anything that's not pass rated, is generally 2.25% to 2.5%, maybe closer to 3% in certain institutions, but generally speaking, it's less than 3%. I think those numbers are very admirable. We certainly weren't there in 2008 and 2009. We didn't have companies disclosing like they do today. Back in 2008 and 2009, you didn't know anything other than non-performing assets and the Texas ratio. Today, you've got a whole panoply of disclosures and information, which makes it easier and frankly should build confidence. It's not, and somewhat because folks are not paying attention, some investors just don't know. They weren't here in 2008. And so they know that it was a crisis, but they didn't live through it like you and I have and many other listeners and professionals out there. I think that the criticized asset levels being low is one of the biggest misunderstandings that's out there. Now, as we go through a credit cycle, these problems will go up. Every bank has issues, and I don't think criticized assets will stay sub 3%. I suspect they go 5, 6%, maybe even to 8%, but most banks can handle that. If you knew how bad criticized assets were at a lot of institutions, I think you would really have been scared about what we did in 2008 and 9. Companies, I think, were deep into the teens on criticized assets. I can think of one company that I cover today and still recommend that if you really knew how bad it was, you would shiver, because their problems today are 2.5 to 3%, just like everybody else, and that's probably about 15% what it was in 2009. And that's why they had to raise capital multiple times to save themselves. And that's not the scenario that we see today. So it's a fundamentally big difference, big disconnect. And again, investors are just ignoring the facts. But I see it more as human nature, and folks think they're missing out, the FOMO. They think someone else on Twitter or in the media knows something they don't know. And so we are regurgitating stories about hiring advisors and companies putting themselves up for sale when it's either old news, in the case of PacWest, they hired an advisor 6 weeks ago, or it's just false, which has been the Western Alliance narrative that's been here in this past hour with today on the 4th of May.
Sure. Yeah, and to your point on credit, we have some strong markers there. While we don't necessarily have the criticized numbers from the GFC, but we know the marks that institutions had to take either through FDIC deals or shotgun weddings. And yeah, they usually were more punitive they end up being, but we're talking like 25% haircuts. 20% haircuts on loan portfolios, and they ended up being a little bit better, but it was still 10 or 15% down, and that's losses, not even stress. I mean, just a far cry from anything we're kind of seeing today. And there's some things, yes, I think we'll look back at this and we're going to look at liquidity differently. We're going to look at probably how we approach the investment portfolio a little bit differently, and we'll look at maybe interest rate risk management differently, and industry concentrations and uninsured deposit concentrations differently. There will be some lessons from this for sure, but there were some things that were done right on the credit side, whether it's greater focus on CRE concentrations or greater focus on leverage when underwriting and higher capital levels sort of going into all this. So there's just a wide variety of things that I don't think are kind of being recognized. I know you appreciate, but I don't think are being recognized by a number of members of the investment community.
Well, that's true. And I also think that a lot of this can be boiled down to a math problem. So if we take office real estate, office CRE, disclosures have been excellent. You generally see that a lot of our mid-sized regional banks have got 6 to 8%. So if you think about an 8% exposure, if everything in your office book goes awry, you're going to take big losses. But the problem is not every loan is bad. So I would argue under a loss given default scenario, an office portfolio might have 20% that gets in default, and then you lose 50% on the 20. But at the end of the day, that pencils down to losses that you can stomach with your own cash flow. Because I think the rest of the CRE book is better than folks understand. Again, it does not mean we don't have CRE problems, because we will. We have a recession that is probably already here, or if it's not here, it'll be here soon. It may be like a 2001 recession where it's a lot more tamer. However, we have talked ourselves into a depression in office real estate, which is just not accurate. I think that there are challenges in CBD. There's going to be properties that are on the market and things that are below value. Most of the banks tend to have low LTVs, sub 60%. And if you go back to 2007, leading into the 2008 crisis, banks were lending everywhere at 100 cents on the dollar, sometimes in the construction world at 110 cents on the dollar. So you lose a lot more money if you're in at 100 than if you're in at 60. Or a lot of property disclosures have been kind of in the upper 50s. You just have more latitude. That doesn't mean that you're not going to see losses, because you will. I'm familiar with a mid-sized regional bank in the Southeast who has taken losses on 2 office properties in suburban Atlanta. They sold these things for 50 cents on the dollar. I think that's a win. Why? Because that bank most likely has 60 cents, 60% LTV on those deals. or let's call it 65, and that they ultimately took a 20% loss. If they sold them for 50 and they're in at 65, you add transaction costs, you round up to 20. 20% loss is not that bad on your original dollar that you loaned, and it all starts with less leverage. So the bank has a charge-off. The bank hits the reserve this quarter, and that will flush out. You and I may never see it because they have other things happening in their P&L that is good. PP&R is still positive. I know margin gets compressed, but companies are still making money. We have a saying on our team at Janney that, margin is just a statistic, but net interest income, NII, pays the bills. NII may go down linked quarter, but it's still there. It's not going to zero. And that's the fundamental disconnect with investors. They're worried about a change in basis points on margin, and they've talked themselves into a negative scenario that, sure, it's a linked quarter decline, but it's not as ugly as you think.
In the situation you just gave, you easily earn your way out of that, to your point, whereas, maybe you blow through the cushion, but what's left is a haircut you can take, a charge-off you can take, and your earnings will support it. So it's not, especially when you think about where we started, where these things are trading. It's not even that you're saying, oh, there's nothing to see here. You say, sure, there's lost content, but they can afford it. And you balance that against where they're trading, and it doesn't match up.
99.9% of the banks are very honest, they're very open, and they will do the right thing. We occasionally see a couple bad actors. I've lived through a handful of frauds in my 31 years. They're not pleasant, and they are few and far between. Most of these companies, if they have problems, they deal with it, they move on down the road. Some may elect to sell and pull the parachute. I think we'll see consolidation. I think we're not there today with stock prices so low. But I think the concept of multiple banks failing beyond the three that have already happened is just false. But if we continue to let banks be a weapon of destruction, then all bets are off. I think we'll see some rationality come into the marketplace. But in the short term, these are dark days, and we continue to fight through it. I feel fortunate that there are real examples of things that do trade on properties and loans that are worked through, and you can point investors to that. And that's the type of effort that we do at Janney. I know a lot of our other colleagues around the street do the same, and collectively, I think we'll continue to win a few fans along the way. But again, the bear case always sounds more intelligent in the short run, and that's the issue that we have. But I think as people continue to dig deeper into the sector and what's really happening, there will be a little bit more rational and a little bit more calmness about the ability of banks to work through the cycle. I think people have just not appreciated this low leverage and the differences we have today, not just in disclosure, but really the fundamentals of the leverage that is a lot less. We're way better prepared for this environment than we were in 2007 leading into 2008 and 9.
For sure. I tell people all the time, you think about some of the things you ran into back then where you just shudder and shake your head and how different and much more deliberate it seems today. Well, and really in closing, and you just sort of spoke to it, what brings people back to the group other than some of our friends who are dedicated to the space? When I mean people, I mean investors back to it. Is it really just kind of this show me story of sorts that as time passes, it's not as bad as they think it is, and that eventually they start looking at valuations? Is that what needs to happen, or do you think something else needs to happen?
Well, I give you two things. From a basic standpoint, tangible book per share is still sacrosanct. And in 2009 and 10, we were raising capital in the hole, and it was painful, and tangible book was getting rewritten all the time. You had accounting marks for DTAs that were further harming capital and TBV per share. We may see a little bit of that in this go-round. I think it's far less. My opinion is that book value in second quarter, third quarter is going to grow. Companies are going to make money. PacWest and Western Alliance are going to see their book value expand despite what the bears and short sellers feel on May 4th. I think that capital being raised in the industry ultimately happens because we still have these underwater securities portfolios that we can't count on the Fed to take rates back to zero. And the Fed may eventually pivot, but hope is not a strategy, and I think banks need to raise incremental capital just to show that they can, just to show a sign of confidence. Ironically, the biggest offender on this is Bank of America. They've got the biggest held-to-maturity book, the biggest change, and I know Brian Moynihan says on CNBC that, hey, we're hedged. It's all good. I think that isn't faring well with the real world. And if Brian truly wanted to be a leader, he would raise capital. It's ironic because the Berkshire Hathaway annual meeting is this weekend after we're recording this, and it'll be curious to see what Charlie Munger and Warren Buffett have to say. I suspect they're very negative on banks, but I also suspect that their checkbooks are open, willing to make investments. And that will change the attitude towards this sector as well.
And it's certainly another corollary that could be a fair corollary back to the '08 period. They certainly did well doing that then.
And it's also a time to be creative. I think that there are times when banks get real creative. There's a lot of good advisors in the marketplace, including our team at Janney, and we can all be collectively creative at solutions. My attitude is every problem has a solution. It was absolutely true in 2008, 9, and 10, and it will be true this go-around. And let's presume that this is going to be a 2003 and 2023, 2024 affair, because it should be a recession and a cycle of credit, even though I do think it's less than 15 years ago. But as we have this, there's ways to work companies back to a safer position and certainly to a better valuation on their stocks. And some of this is positioning companies for sale. Some of it is having companies make the strategic change that they need to do anyways, but it will position them not only to survive, but to take advantage of the opportunities that always occur when you have these market dislocations.
Well, fantastic. Well, Chris, thank you so much for taking the time to talk with us. Great insight, great thoughts.
My pleasure. Anytime, Nathan.